Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard. We're fresh off of a seminar that we did last Friday. It was kind of fun to get out there and meet some of our listeners. You know, Victor and I were talking before the seminar, trying to organize our thoughts and what we're going to talk about. And I was saying, well, you know what? I'm going to get out there and I'm going to ask for a show of hands. How many people out here have heard our show? And then we were thinking, well, you know, if only one or two people raise their hands, maybe we should go for numbers, right? And say, how many have not heard the show? Get a big response. And then we'd say, we'd like to invite you. Good news is, and the reason I went into all that was to say this, we were in the back of the room before the seminar started, meeting all the folks before we got up there and did a little bit of talking. And I'd say a third or a fourth of the people had seen the show, had heard the show, had came up, introduced themselves. And if you're listening, it was very nice to meet you and a pleasant surprise.
That's right. Every time I get the reports, we're the number one rated listen to show, financial show in Dallas. Number one show good on most of these, as far as all shows on the weekends. Some of the weekday shows are different, but the weekend shows, we've dominated that for a long time. I think because, like I said, we try to give information. Some of the shows is basically just an hour-long infomercial on how to come to my next seminar. We try to actually give you information you can use.
But it's a double-edged sword. You know, we try to be consumer advocates, right? A lot, and warn against unregistered investments and, you know, all your axis of evil with the banks and all that. We'll get clients and people that call us for questions, and we'll work with them for several years. And they say, oh, I didn't know you were an advisor. Well, yeah, that's what we do. It's funny.
Oh, I had an advisor tell a client that they didn't make any money on this particular product they were trying to sell them. I was like, you didn't buy that, did you? I go, really? I go, there's nobody doing this for nothing.
Do you remember what the product was? Or?
I think it was an annuity.
I think
it was an annuity.
They said, everything.
I don't mean, just because you're not charged out of your account doesn't mean they're not paid.
Right.
First step, if you ever hear somebody say, I'm not paid on this, then why are you calling me? You know you're already dealing with somebody that's lying, you know. If they're going to lie about something stupid like that, there's no telling what they're going to tell you. And remember, the reason why we called this show 20-something years ago the Common Sense Investing Show, because if you put just a common sense test, just do a test to anybody or investment strategy or anything else, you'll find it doesn't make sense most of the time. And I was like, it's like when they brought us the Dog and Pony show from Waco, that Life Partners Inc. or whatever.
Oh, many times.
Life Settlements Inc. They brought the big high-powered people. They knew I was a veteran, so they brought two retired officers with them that are also doing the program. They thought that would convince me. Remember, everything is suspect to me unless it's researched. I mean researched. I'm a detailed dotted, you know.
Kind of like Ghostbusters, but with finance.
We go over every day. The first thing I asked was this life settlement thing. I go, what if they live longer? Because you said I'm going to make 20% a year if they live 4 years. What if they live longer?
Die in 3 or 4 years.
He goes, well,
which is morbid.
You make a little bit less, but most of the time you're going to have them die early and late. Average always is about that. And then years later, I saw a Wall Street Journal report that 99% of all the people they insured at Life Partners Inc. were still alive after 10 years. So I go, wait a minute, 10 years means you're actually eating into your principal. You have to keep pumping money into these policies just to get part of your money back.
And these are made up numbers, but think about it. You've invested $100,000 probably out of your 401k because they don't care where they take the money from.
Nope.
And they've got enough reserves to keep these life insurance policies in force until the death, which is morbid anyway, yes? Yes.
Oh, yeah.
And now they're living longer. They've used their whatever little reserves they have. You've got 100,000 in, and they're telling you if you don't send me $5,000 each and every year to keep these policies in place, your $100,000 is going to be gone. So now you have to make a decision. Do you chase bad money with good?
And not everybody chases it. They'll just write it off.
Let it go.
So whatever their premium was, now you got to pay that too.
Oh, that's right.
No matter what,
the aggregate, that's right. It gets
so
bigger.
If half of them drop out, Not only you got to keep paying premiums, your premium just doubles.
That's right.
And over the longer it takes, the more people drop out. Just call it a day. That's the more and more you have to pay. So basically, just to recover part of your principal, you're paying a fortune just to recover part of your principal.
Yeah, it wasn't a good plan.
They're just not good. But remember, there's those key things. If they can't answer the question, thoroughly to your satisfaction, hang up the phone, let them go away, walk out of their office, whatever. There's like key things like this is IRA approved. See, we can use your IRA. We can take anything that, by the way, the IRS does not approve investments, period. They don't approve a type of investment. They don't approve anything like that. A custodian will figure out a way. There used to only be one. It was in Waco, actually, again, or Waxahachie, one or the other. But just because you can do something doesn't mean it's good or approved.
That's right.
IRS does not approve of any investment. They will never approve any investment. So if somebody says that, you're talking to one of two things, a crook or an idiot. And you got to remember, there's only one or two. Just like they say, we're going to beat the pants off a 401k. Don't invest in your 401k. You need to invest in this real estate deal, whatever. That's either an idiot or a crook. 401k or an IRA is not an investment. It's a holding vehicle, so it depends on what you have in it.
And, there's nothing wrong, and we talk about allocation based on your age or time horizon. If you want to take $1,000, depending on how much money you have, it may be 10. But if you want to take $1,000 and put it in Bitcoin, because that's going to be the next thing, you want to invest in marijuana stocks because there's some penny stocks that you think it's going to be the next alcohol product and it's going to be legal nationwide, you have some fun and do it. But if everything is done within the proper allocation, it doesn't change your plans for lunch the next day.
Yeah, just remember, keep a common sense approach. If you can't answer certain questions, what to do it? Like the life settlements, they don't tell you, you got to put in more premium. If they tell you, well, it's not going to happen. Anything that's private,
it may happen, but it is so doubtful.
Those are usually a life insurance policy because they never disclose everything until they give you a dang policy you can't hardly read. It's 1 million pages, and a lot of times they don't disclose it. If you're talking to somebody that's not licensed or a fiduciary, you got to be careful. But private investments like life settlements, like oil wells and all this, and a lot of these real estate deals, there's no license, there's no background checks. It's the Wild West. They can do whatever to you they want. In other words, I'm buying this apartment complex, and I'm charging you $20,000 a month for rent. Yeah. Next year, I can charge you $50,000 or $100,000
because I'm managing it. You go ahead.
Yeah, they'll say, I remember on the life settlements thing, they said, Warren Buffett, this is how he's made his fortune. This is how rich people actually make their fortunes. I'm like, you're full of crap, right? He goes, no. I go, Warren Buffett might buy a life insurance policy from someone.
He's
right?
a fundamental guy.
He's not going through a marketing organization that's tripling the dang price of it and the profit, all that's involved. He's buying it direct. I go, so there's a huge difference. They'll try to put a little bit of truth in there, try to make it theirs, but Warren Buffett has never bought a dang Life Partners insurance policy. Never.
It's so funny because we do this day in and day out. We're so conscious of prospectuses and contracts and what to watch out for, but on a daily basis, you and I probably sign those user agreements for apps and internet stuff that sign away all of our family's information for the next 5 generations just because you don't want to read 84 pages.
Well, I'll tell you what, I had that, I got those Alexa things at home, right?
Yeah, oh, yeah.
They say they're always listening to you, and I was like, oh, come on, that's one of them conspiracy theory, Big Brother deals.
Right.
I just thought I'd play with it. I didn't know it did this. Pardon me, I'm 55. Some of you younger people say, of course it did that. Yeah. Well, I'm just saying. I just said, call Guy Allert. It starts dialing the phone. And I'm like,
where'd he get the number?
Yeah, right. How the heck did he have my number?
Right.
It has every number, every kind. I'm like, did it get it out of my iPad or my phone?
Could you say to call Nancy Pelosi or something?
Yeah.
If you
How
want?
did I connect this Alexa to my phone? I didn't do that on purpose.
Give her a piece of your mind?
Yeah. Because I'm trying to think, how did it connect? It knows you can say anything. I said, now I knew you could call another one, like my daughter. I'm saying, call Tori's Echo or whatever.
Right.
But how could it call all these people? It somehow got hold of my entire contact list.
I bet you could say, call my congressman, and it would get your location, and it would dial the number. I bet you.
Yeah, I like a lot of smart things that those do, but some of it kind of scary. Because you're like, yeah, it was in that user agreement. You can't go forward until you click the yes when you're buying the app or whatever.
That's right.
Or you're downloading the app. And you're like, okay, it's just standard crap. Well, they probably got a deal where my 4 generations of my family owe them $1 million or something. You never know.
That's right.
But I could not believe. I'm like, this thing knows all that? Or they said went to that seminar, and the guy was telling us about these predictive kind of things.
Yeah.
All the smart TVs, all the Alexas, all of them are listening always. That what they're doing is they're going to say, you're talking to your family about vacation. You'll see the ad pop up on the television and your iPad that says, hey, here's Colorado vacation.
That's right.
That is exactly what's happening, and you can't get out of it, apparently, if you're dealing with Facebook or anything else. Well, we got a great show. We're going to talk a lot about retirement today. We got a couple of great strategies for you. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. I wanted to mention again, we talked about it last week, but the RMD strategy we talked about, remember, required minimum distributions. For those of you unaware, if you have a 401k, IRA, anything else, now if you're still working there, that doesn't apply to you. Stop working there with a 401k. Everything else it does. At 70.5, April 1st, after you turn 70.5, you have to start taking money out of your retirement accounts, whether you want to or not. So we know it's going to go, and they're going to increase the amount you have to spend every single year until you die. The purpose of that is, at 70 years old, this person could have put that money in at 30. The government's never got any tax money. This entire 40 years, no tax money.
They don't like no money.
No. So they're saying, okay, we got to get some tax money. If they end up dying and send it to their heirs, and we go on their life expectancy, it'll take us 50 years to get the money. So let's start now. Let's get 70 and make them deplete it. The issue with that is a lot of people, let's say you've got $1 billion IRA. It works same if it's a $100,000 IRA or a $10 million IRA.
But $1 million's more fun.
Yes. So you got $1 million IRA, and you don't spend a whole lot. Your income needs are pretty set with Social Security and pension or whatever. And you're like, I'd just like to pass that on to heirs. But, man, the government's going to deplete it with those RMDs. Well, we talked about a strategy that will guarantee it. Like if you put $1 million in, remember they're going to take, it's like 3.5%. It goes up every year. But let's say it averages 4% a year for the first 15 years. It's higher than that, but at the end. But
it goes up.
All right, let's say it's 4%. So I got $1 million and I'm going to take $40,000 a year. Let's say that it's making just enough to make up the withdrawals or whatever. But you spend about $600,000 out of the $1 million when you're 85, so 15 years. What if we could guarantee you keep that $600,000 and guaranteed to your heirs is that same $1 million?
Yep.
No matter, you spend $600,000 of it, and no matter what, guaranteed to the penny, it's gonna. Now, if it makes,
and it's still an IRA for them.
And people say, well, maybe if it makes more. Well, if it makes more, you get more too. If we're talking about the downside protection. Upside is, of course, if you make 25% a year, you're going to leave them a hell of a lot, and you're going to take your RMDs.
And if you have any questions on this stuff, as we've told you before, our number is 972-715-2424. Victor or I personally return all those calls. Again, with all the volatility, we've been extremely busy. Give us a day or two, but we will work through the calls.
Yes, we've been doing this 30-something years. I don't know if I've ever seen the market's been so volatile.
That's not for the weak.
When the market's going great, everybody's fine, no call. We're getting inundated now, which is a good thing, because the strategies we've been using, all the stuff's come to fruition where, hey, this is actually working.
That's right.
But remember, if you have that IRA, or let's say you can live off the income from it, the RMDs are fine, but you still would like to leave the full amount, we can guarantee that.
How about that?
I know. 972-715-2424. Because once you get older, it's really hard to keep an IRA together, 401k, because those RMDs start ramping up pretty strong. If you're single, they ramp up faster, right? Because what they do is it's the joint life. It's a longer lifespan for two people, obviously. One lives longer than the other, right?
Sure.
Than one person. So if you're a single person especially, they're really going to make that sucker go down. And so if you can have something that guaranteed that same million to your heirs, whatever that IRA is, no matter what, and you get to keep the RMDs, and that's on your worst case.
That's right.
Best case, you both get more. It doesn't change the best case. You still both get more. Call us at 972-715-2424. Again, 972-715-2424.
And the neat thing about that, if I can jump in, because you look like you were headed down a path, there's many different things. It just depends what you need and what you're trying to do. You may not want to pass it. I've heard Victor on the show say many times that his kids can have everything he doesn't spend.
That's right.
We've got ones that will give you tremendous income based on the amount of dollars in compared to anything else that's out there. Also provides some long-term care benefits and different things along that line. If you don't need income, some people are blessed with huge pensions and the Social Security, and my favorite ones are the ones that don't have real high expenses, right? They got like $3,000, $4,000, $5,000 a month, which when you have Social Security from two people and a little bit going on, that's easy to do. They just want deferred growth. So there's many different things. You don't have to be a round peg in a square hole. It's got to be custom tailored to your needs.
What you have is a lot of people start with an advisor in their 30s, 40s, and stay with them to their 70s, but those people manage the money the exact same way. When you start getting to the distribution phase of your life, retirement age, stuff like that.
Different phase.
These strategies are they're detailed, but they work. They maximize either income, benefit to heirs, all kinds of different things. You can get less taxes. There's all kinds of things you can do. We happen to be distribution specialists, and so you don't want to, like I said, you don't do a growth investing for someone that's in the distribution phase.
That's right.
And distribution might be, I want a certain amount of income, but I want to maintain my principal. I don't want to eat it up.
That's right.
Just depends on what you are, and we can show you strategies that do either one. A question came in that I thought we'd share with everybody. Anytime I get a question, I want to share it with everybody if it's common.
Everyone loves the questions.
Oh, yeah. If you inherit, the person called in and said, I inherited or what if my daughter inherits a Roth IRA? Does she have to pay taxes? I was like, that's a good question. You don't have to pay taxes on a Roth IRA. It's already been paid. But you will have to take RMDs just like if it was a regular IRA. Spouse does not. Any non-spouse beneficiary has to take distributions from that Roth immediately.
Where the owner didn't have to.
That's right. We got a break coming up, folks. Remember, if you have any financial questions, you'd like to take advantage of any of our services or like just a welcome kit, call us at 972-715-2424. Again, 972-715-2424. Remember, you can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. All right. Remember, we had a welcome kit. We offer several no-cost, no-obligation products. One is our welcome kit. Tells us a little bit about ourselves or some products if you're interested in them.
Some good white paper.
Yep, we got white papers in there. I'm a student-type mentality. I love reading everything, It's weird. I haven't read a book for pleasure in 20 years. I read, financial publications every single day.
That's about mine, too.
That's all I do.
Yeah.
I read the newspaper every morning, and that's becoming depressing every single day, it seems like.
Well, we talk about it a lot. This is all math. Right. And also we mentioned the number one reason to have an advisor, as stated by professors, not by us, is because it takes emotion out of it. What we're very proud of in these welcome kits and are happy to provide for you is it shows pretty much all the investments from the spectrum, from stocks all the way down to money market accounts. Where's the best? It compares them, what the rates are, what the terms are, what does what's protected, what's not, what's taxable, what's not, some spreadsheets, some 18-page white paper, and what do you do now because bonds rates are going up? You don't want to get stuck in a bond. What's the alternative? There's some really good information in there if you'd like to look at it.
Remember, we offer a retirement plan, a written retirement plan. You'll see sometimes they'll put this regurgitated generic thing, but it doesn't have all the specifics. It's the most comprehensive plan I've ever seen. It basically shows what is your let's say you're 60 now. what does your life look like at 80 with just standard inflation hitting and all this kind of thing?
What if one of the two of you pass away? What happens to the expenses?
We will
then?
show you exactly to the year. If one of you passes away, here's what happens to the other one, or vice versa. Or if you both live to be 150, we'll show you that too. But it's actually, instead of just trusting someone, which there is a certain amount of trust in this business, I like the numbers. I'm like the Reagan, trust but verify. That's my thing. I want to see the numbers, and if the numbers work out, maybe I'll call you, or maybe I'll consider doing business with you. That's the way I do business. That's the way you should do business.
We always shoot straight. I had a real nice retired school teacher came in earlier this week, and I didn't look at her statement until the very end because it was a 403B. You know, usually you do that towards the end of the deal. Went through all the paperwork, went through a plan, set her up nicely to get retirement income. She had a certain number she was trying to get. And then she handed me the statement, which we need for the paperwork, and I looked at the statement. She had been in this plan, and it was a fixed annuity, for 20 years. And here we were getting ready to set her up, and I thought she was in mutual funds. Here we were getting ready to set her up in a new one where she'd only defer it for 1 year and then get income. The income she is going to get is twice what we could get her, only because she had it deferred already for 20 years. And we had all the paperwork done, all the paperwork signed. She was gone. And I had to call her up, and I had to say, listen, where you are is the very best place. We're still happy to help you. Anything we need to do when you're ready to turn the income stream on, call me. As I tell everyone, my fee is, next time you hear someone say, man, I wish I knew somebody that could help me with my finances, you say call McClure Capital. But That's just how we operate, always.
That's right. Well, we've never had a complaint in 30-something years
That's
because
right.
of that. We turn down a lot of business around here.
That's right.
Because it's not suitable.
Stop that.
It's not in their best interest.
Stop doing that.
Oh, sometimes we'll hire, a person from retail side, and they're like, what are you doing? I'm like,
yeah.
This is different. People trust us with their life savings.
That's right.
They're not buying a car. It's got to be like this. There can never be a gray area. There is no gray area. So call us. Like I said, if you'd like to take advantage of a written retirement plan, we also have a Social Security optimization program that's very helpful. Shows you the real numbers behind starting at 62 versus 67 versus 70. I mean the real numbers with cost of living adjustments. You'd be shocked. Is it always in the best interest to start at 70? No. You might have heard that before. No, it depends on the situation between the amount of the age difference between you and your spouse, the income difference or disparity between you and your spouse. So many things factor into that.
Man, when they stopped that file and what's the word I want?
Suspend.
Yeah. Man, that changed things up, though. I hated that.
Yeah. And some of you still have that. It's not gone completely for some people. It still might work. And so there's also, if you're married for 10 years, you got divorced and you were a homemaker, you still can file on the husband's Social Security as a spousal benefit, even if you haven't been married to him for years, as long as you were married for 10 years.
That's right.
So there's little rules like that you really need an experienced retirement advisor for. I'll give you one quick thing. My kids, I have 4 children. People know this. I say it all the time. They're 32 down to 10. So they're all over the place, right? Some of my kids, if I died, they would handle a lump sum pretty good. They're not going to go broke. They're not going to buy a bunch of bass boats
and Camaros. I'm sorry.
Okay, there's really just one. The other 3, no. So what do you do if you have a thing where if you and your wife or you and your husband get hit by a bus, these kids are going to get this. How do you do something with it? We'll talk about that after the break.
Good point.
But our number again, 972-715-2424, or our website is ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. Right before the break, I was talking about my 4 children and how one of them could handle a lump sum of money pretty good. The other 3, not so much.
Jury's still out.
That's right. Maybe as they get older.
Yep.
Maybe.
Yep.
But so how do you, what do you do with that? Well, there's certain things you can do, trust and things like that. But when you don't have much of a complicated portfolio and you don't want to go to the expenses of a trust, there are other things you could do too. Plus, trust, there's still costs involved. You have to have a trustee to do this. I'm talking about, I want to do it on the cheap, but I want to make sure I get the same thing.
Control that money from the grave.
I don't want a probate lawyer taking part of it and then start dolling it out, and now they're trying to interpret what I meant.
That's right.
I don't like all that stuff. Just give me a plain deal. All right, I want this kid, I want 10 years of payments. This kid, I want 20. This one here's real bad with money. He gets life payments because it's going to be a little amount, but it's going to be for life because they could be screwed up for. I'm not talking about my kids. They listen to this show, of course. We're just making crazy examples, kids.
We're talking about your kids out there.
These are crazy examples of other kids, not yours. Right. But that's what you have to do. Some people say, well, my spouse would be broken in 18 months. If that's right, sometimes you can do it. But the laws for community property, all that, a lot of times you can't do that. You can't designate. Like you hear these stretch IRAs and all that. Well, the stretch IRA is good as until somebody doesn't want to stretch it anymore.
I've had, and I know where you're going, I'll let you get there. I've had a lot of people ask me because they know we do stocks and fixed annuities and we've done managed commodities and the whole gamut. But they've asked me on fixed annuities because of all the good and bad press and say, really, what is a fixed annuity? Well, if you think about it, to me, in the simplest form, a fixed annuity is kind of a hybrid between an IRA and a trust. It's got some of the benefits of a trust. In Texas especially, it's creditor-proof unlimited, which is what trusts will do. And even if it's not an IRA, if it's non-qualified, when you put your money in there, it grows tax-deferred. And if you take it before 59.5, there's a 10% penalty. So it really is a hybrid. And then now you were going to talk about controlling the distribution, which is like a trust.
I like the idea of control the distribution because, different kids have different things. Now, when you're older,
how does that work?
Like I said, I got a 32-year-old. You could have 60-year-old kids, and that's fine. But some of them are better with money than others. I don't want to disinherit anybody, but I also don't want to ruin their life.
How does the controlling the distribution work in a fixed annuity?
So what you could do is you could designate the actual payout. You could say, I want this child to receive this in 20 equal payments or monthly for 10 years, all those kind of things.
Without setting up a trust.
So it's basically like a stretch you can do, and you can do it with non-qualified money instead of just an IRA stretch. And so I like that flexibility. Okay, when you can package it in a certain way where you get up years indexes, no down years, you're tax deferred, you're judgment proof, you avoid probate, and I can dictate to the heirs. There are so many benefits. You just got to choose the right one. Stay away from the high fee garbage.
Yep.
Stay with the low fee to no fee stuff.
No variables.
And make sure that if they offer one, it's probably not the best. Trust me, the biggest firms in the world offer the least amount of products. Isn't that weird? You think it's the opposite, right?
Absolutely.
Independents offer more. If it's available, I can offer it unless it's private labeled, which there's only about 2 or 3 of those.
And we have those.
Private label annuities and private label mutual funds are never competitive. They're trying to dig out extra fees, typically. It's not a competitive deal, because if it was competitive, they would let the market compete. That's capitalism, right? They don't let it compete. It's not. I've never seen one yet. Okay, I'll take back.
Security Benefit had the one that was private that was really good for income.
Yeah, I'm talking about that. I'm talking about as far as this is open to everybody.
Gotcha.
That's open to everybody. That Security Benefit was open to everybody. Some of them, like they had I think it was a Bank of America annuity or Bank of America mutual fund or something like that, and they're never good. Usually it's another one. It's just tagged on. And so there's all kinds of tricks that big companies could do to you, institutions can do to you. Like, I'll give you an example. Variable annuities are the ones we hate because the fees are ridiculous.
And there's some that are good there, too. Even.
Vanguard, maybe, decent, yes. TIAA crap, they're not bad.
So nothing's absolute.
That's right. But what they did was they always had mutual funds. And they made money on the cost of the policy and the insurance or whatever, right? But they said, hey, people are starting to get wise to these fees. How do we still make money, more money maybe, but they're not wise to it? Well, let's start a new share class in of the mutual funds. In other words, they think they're getting American Funds Euro Pacific Growth, and they are. Right. Same stock, same manager. You just didn't know they're taking out another 0.5% out of that thing because it's a variable annuity share class. Remember in the old days, you had 3 share classes of mutual funds, A, B, and C.
Yep.
A's was the ones that we've had for 100 years. That was the loaded kind. Well, people didn't want to pay loads, so they came out with a B share, which as long as you held it 5 to 8 years, you don't have to pay the load.
That's right.
You didn't tell you they're paying extra fees every year, though.
That's right. Cost.
Right, and that stopped after, say, 8 years. And then say, well, people don't want to pay anything up front, and they don't want this. And we'll come out with a C share, which charge them just 1% a year, right? Well, the insurance companies had this great idea. Let's charge them another one. How about an N share or this share? We can use those, charge more. They put it in 401ks. They put it in life insurance contracts, annuity contracts. Nobody's going to be the wiser. Yeah, it's in a prospectus that's 800 pages long that nobody looks at. But if you look at that fund expense, that American Fund Year Pacific Growth versus outside retail product, it's almost always higher.
And it's hidden within the fact that they call it a NAV, an acronym for net asset value, instead of a pure stock price and a transactional cost. Everything is an aggregate of the net asset value, the NAV, so you don't see all the little variations.
Oh, we've been doing this 30 years. You know how many people say they don't pay any fees to mutual funds? How many times we've heard it?
Oh, yeah.
I've never seen a bill. Mutual fund companies are the greatest people on the planet at hiding fees. Basically, if it made 10, it really made 12. If it lost 10, it really lost 8.
Yes.
Because trust me, it comes out beforehand, and they do that quarterly, so it has an inverse or a negative compounding effect on your money. We got a break coming up. The engineers throwing the hands at me.
I see it.
Remember, if you have any questions, call us at 972-715-2424 or go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Going over a few money strategies today. Remember we talked about inheriting a Roth. If you want to spend the income from the RMDs, and how about we'll guarantee the full amount to your heirs, even if the market never goes up, nothing ever happens. If it makes more, you get more, obviously. But your worst case is you spent $500,000 or $600,000, the heirs are going to get it all back.
And there's a nice little brochure if you want to take a look at that. It's an easy deal. They'll stick it in the mail to you. No big deal.
All right. Here's another strategy. Let's say you're a 501(c) company, a charitable organization, and you have funds that you need to invest. I want to get a better return. Basically, the bank controls like 90-something% of this because there's a rule with them that you have to keep this money pretty safe, okay, when you're investing on the name of a church or
absolutely
any kind of company. Well, we have a few companies that will do it into much better products, much better yield. And there's all kinds of the other benefits. So you can actually have, if you run a church or any of these charities, it'll still be in the charity name person. You could have, the director or whatever as an annuitant if it's an annuity or whatever. But you can get a lot better return than the bank's giving. I mean, a lot better. Have more control and get a lot more benefits. There's probably 5 or 6 other benefits on top of that. And so that's always been an issue with nonprofits trying to find decent places to invest without taking too much risk.
We've got some real good ones.
So call us if you're one of those. It's 972-715-2424. Again, 972-715-2424.
Now, I understand Harvard is for profit, but if any of you out there that manage the endowment fund, please call us.
It's like $700 billion. Some crazy amount.
We will make time to work through that for you.
Or the California pension deal. That's the largest pension endowment in the world.
That's got to be underfunded, isn't it, in California?
It's got to be, right?
Yeah, I'm thinking it's underfunded.
Oh, my God. All right. Here's another big tip. I'm a small business owner. I know a lot of small business owners. There's one mistake, I'd say, 80% of them make, maybe? It's a huge percentage. But it's normal. It's natural. The mistake that most self-employed make, or very small business owners, is they expense everything out, don't pay themselves much, right? They just use out of the gross profits. They use that's what they pay their bills with. The problem with that is, the positive part is, hey, you don't have to pay a lot of Social Security.
Taxes are low.
That's right. Taxes are low. Don't have to pay a lot of Social Security. Ooh, that Medicare is a bear that never stops.
Hard to get loans, though, because you're not showing much income.
That's right. That's one thing.
All right.
Showing that they're like, well, you don't show any income. Well, I got this business with all. I don't care about that. Where's the income from here? You're not getting a business loan. You're trying to buy a house, right?
But I grossed $1 million.
That's right. The real problem is this. Now, I've found this with several of my relatives. This is to me, it's a rampant problem. They don't realize what they're doing. So let's say, what's the max Social Security? Now this has gone up, right? $130,000, I think, this year at 6%, right?
Yep.
So what's that, $7,500, whatever the max Social Security. So they saved that, and they're going to save it for the next 10 years, let's say, till they retire.
By
right?
lowering their taxes.
So $75,000. I know it's gone up, but it was lower before years. So let's say you saved $75,000 in Social Security. The problem is, by not paying yourself that stuff, your Social Security might be $1,200 a month.
Opposed to?
Right. At 70, it could be $4,000 a month.
How's that working for you?
Now, think about that. Think about this problem. I like I said, I had relatives. They had nice homes. Everything. I know they made $250 a year, but they were able to expense it out. But then when they got disabled, which they did get disabled, they were having to live on $600 a month from Social Security. $600 a month. Try that.
Yeah.
So think about this. I saved $75,000 in Social Security. In another, so a little bit in Medicare or whatever.
Over 10 years.
Yeah, sure. So, but this $4,000 a month, if I lived to me and my wife, remember it's for two people. The longest, if one of us lives to 95 or whatever, $4,000 a month. There's
$50 a year.
Yeah, there's $2,800 a month. All right. So it's about $32,000 per year. So you save $75,000 total. But you're losing $32,000 every year for life. You live 20 years.
You doing it after tax?
$640,000. Yeah, I just said 2,800 times 12. All right.
I was at 4,000 a month times 12.
No, well, you were getting 1,200 if you did the other way.
Gotcha.
So I'm just taking the difference.
Gotcha.
So you saved 75 total over 10 years, but you lost $32,000 a year for the rest of you and your spouse's lives. If one of you lives, 30 years, you've lost $1 million. Just by saving $75,000 in Social Security.
I believe $32,000 goes into $75,000, like just over twice. So it's just 2 years worth of payments.
That's right.
Yeah.
But people don't realize it because it makes sense. I'm a small business owner. I don't want to pay that $7,000 in Social Security tax. Come on. Well, the Medicare that never stops. Remember, it used to stop at the same as Social Security, and it never stops now. But this is what you're costing yourself. Even if you think Social Security is the biggest ripoff in the world, trust me, we have ran the numbers. It is, as far as payout goes, even though it's skewed towards the lower end, you can't beat it.
You would do it all day if you could find any investment that would return to you at Social Security.
Most of these Social Securities,
promises to.
The average Social Security might be worth $750,000 to $1 million. And so you're giving up $1 million to save $70,000 over 10 years. It's not worth it. They count 35 years of Social Security, but they'll put weight on the highest 10.
120
So it goes about 35 years, but the highest 10 has a lot of weight.
That's right.
And that protects you if you got part-time work before you actually retire. But those kind of strategies, you really have to put the numbers. The numbers never lie. People's opinions can be wrong. A statement can be wrong, but the numbers don't lie.
Absolutely.
And we'll show you those numbers. Call us at 972-715-2424. Again, 972-715-2424. You got your no-cost, no-obligation retirement plans. You got Social Security optimization.
Welcome kit. That's it.
Again, 972-715-2424. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.